So hi everyone. Uh, Today we have actually brought the outlook on the markets for the month of September and also for the coming months. And the way the market is, behaving, we had seen initially the profit booking in the market, but still the mid and small cap space remained quite buoyant, and we have not seen that kind of any materialistic, profit booking in both of these indices. So that shows the momentum is definitely there towards the broader market, and the dollar positioning also, though the dollar has little bit reverted from the lower levels, the dollar index, but still it has remained subdued from the previously higher levels, and that is also one of the reason which is attracting FI flows into the Indian markets right now. So I just bringing in the major outlook now. So let us start with the presentation. If you look at the improving trends in the market, obviously it is driven from the various investors, investment in the Indian markets or their announcements going forward, what they are going to do in the Indian markets. So Temasek, which is a Singapore state fund, it has plans to invest $10 billion in India over the period of 3 years, and thus increasing India's contribution. Total contribution is around $287 billion. So that means it is increasing from 3% to 6% now, which is very significant into the Indian markets. The iPhone manufacturing in India is about to reach 50% by 2027, almost at par with China. So this is another significant step towards the manufacturing push in Indian markets by one of the giant actually of the global market. When you look at Elon Musk, it took some time for this company, Tesla, to come into the Indian markets. Now they have decided and they are looking for vendors, and they have said that they will manufacture 5 lakh electric cars in India in the coming years. Now, if you look at Walmart, they are investing $8.5 billion in e-commerce and payments. Amazon almost $15 billion, Google $10 billion, and these flows have continued. If you look at the India's current account deficit now, it is less than 2% of GDP. In fact, in the last quarter, it came closer to the surplus when we compare with minus 4.4% of GDP, which was there in the month of September 2022. So there is a significant reversal actually from a deep, deficit in current account. If you look at the India's number of unicorns in India, so it is almost 105, and it is going to be in the coming 3 years to up to almost 250 unicorns. That means almost 140% increase is going to be there, which is also very, very significant achievement. And just second to US, where it is around 618 unicorns. The peak power demand, had risen to 231 gigawatt, but again, recently it hit 240 gigawatt. So the power demand in India is also increasing. We have seen Coal India, because ultimately the power is required. So thermal power is also being pushed, but also the renewable push, which is also major by the Indian companies. But Coal India, which is in the coal mining, it has seen a very, high increase in the mining of coal. So almost 81 million ton record high increase in a particular year is seen actually from Coal India. Indian carriers flew an average of almost 3,72,000 and 840 passengers per day in financial year 23, which is almost 60% higher than financial year 22. However, still 3.6% lower than the pre-pandemic. The PLI benefits in electronics has pushed government of rupees 5124 crores as of December 2022 versus financial year 23 target of 3726 crores. So the government expects, the total electronics production of almost 8.12 trillion in coming 5 years. So out of which 60% is likely to be contributed by the export orders. So all of this is happening. And this is where the Make in India push by the government and finally a lot of investment by the outside players is leading to a very resilient Indian equity markets. If you see the initiatives taken by the government, to boost the manufacturing, so there are a few steps. First of all, they started talking about Make in India. Then they started talking about the PM Gati Shakti plan. Then they introduced the PLI scheme, where almost 14 sectors so far has been benefited. 1.97 trillion rupees they are talking about to be given. Initially they started with one or two sectors, but now it is 14 sectors. That shows the attractiveness of this particular scheme. Export promotion by the government. In fact, recently there was a new foreign trade policy announced in 2023. The SEG Act replaced with a new legislation to facilitate states to become the development hubs. This was also a very good step in order to push these states. If you look at the FDI norms now, so almost 13 free trade agreement the government has already signed. Several sectors have opened for 100% FDI through the automatic route. And this is all leading to the inflows which I was talking about from various players, big giants in the markets. And because of this, ultimately in the manufacturing space, we have seen the new sectors emerging, whether it is renewable, whether it is defense, right? Whether it is, some other sectors like even in the railways, you have seen that kind of expansion happening. Even in PLI, you have seen that kind of expansion happening. So many sectors are emerging now, and let us focus one by one on some of these sectors. In defense, I think if you see this chart, this is a defense export chart. From financial year 17, where it was hardly, any major move. It was 700, 800. Now it is reaching to almost 16,000 crores in financial year 23. So in these 6 years, you have seen a significant jump in the defense exports. In fact, in the last 2 years, it has picked up very, very fast. And this is a trend we may see going forward also. So this right now, this particular sector is more dominated by the PSUs. Almost 80% government-owned companies are there in this space. But there are also some private players which are going to enter. Going forward, we may also see a move in space because L&T, HAL, they are talking about moving into space, launching the satellites. So far, the orders are given in aircrafts. HAL has been benefited. Armored vehicles, you have seen Bharat Forge is coming out now, which has announced the armored vehicles. Naval vessels, you have seen the orders moving into Mazgaon Dock, Garden Reach. Missile technology is coming up, small arms. So you have seen that in missile, if you see, Bharat Dynamics is going to see the order inflow now going forward. Electronic warfare systems, Bharat Electronics is there in this domain. So there are so many things now, various type of orders which are coming to the defense companies. In fact, another interesting highlight is if you look at the order book position of HAL, it was around 82,000 crore. The market cap of the company was around 1.25 lakh crores. Bharat Electronics had an order book of 62,000 crore. So just 20,000 crore lesser order book. And the market cap also was close to, 35,000 crores. Mazgaon Dock, which is a debt-free company, had an order book further 20,000 crore lesser than Bharat Electronics. So how much could be the market cap? It could be another 25,000 or 30,000 crore less. But so that means ideally it should have been around 70,000 crore, but actually it is 35,000 crore. And that is where when the market is, was down to 19,200 something, we saw these companies were participating. The reason is this, that the market cap have been very, very distressed in these segments. And when the order book situation is improving, you are seeing that from those distressed valuations, they are reverting back. Garden Reach Shipbuilder has an order book of almost 25,000 crore. So ideally, when I compare with Bharat Electronics or could be prospective market cap of Mazgaon Dock, its market cap also should have been somewhere around 40 or 35,000 crore, or maybe 30,000 crore, but still it was around 6,000 crores. So that is the reason that these companies now are seeing that kind of buying happening. And if the order starts coming in, I think this may be just the start. Initially, the move brings some kind of stretch valuations, but over the period, I think the sustainability of the orders can lead to the sustainability of the returns also. Electronics manufacturing is also a big thing. Mobile phones, if you see, 43% of the total electronics manufacturing is contributed from mobile phones. We have also seen other consumer electronics, industrial electronics. auto, IT hardware, all of these components are there in various segments. We can see that electronic goods participation coming in. In fact, you look at this number, the India's electronic goods exports, they have clocked $25.3 billion in financial year 23, right? These are the export numbers. This is the way it has moved up. So almost $25.3 billion it has clocked in financial year 23, which is a stunning 49% since 2021-22. So it's a very sharp increase which has happened in the export of electronic goods in India. So if you remember mobile phones, we were net importers, but now we have moved into exporters also in this segment. So there is a long way to go still, because China exports $900 billion of electronic goods, right? So we are just $25 billion. So there is a long way for Indian markets if the policies remain intact, if this velocity remains intact. I think there is a lot more to be achieved in this domain also, and that is why the companies which are there in electronics manufacturing, they are going to be benefited. Recently, the government has also put a ban on PC, tablet, and laptops to encourage the local manufacturing. Now, the next, if you see decarbonization, the renewable energy, electric vehicles, green hydrogen, ethanol blending. So all of this is coming under decarbonization, right? So we have seen that the wind power is contributing to the total installed capacity of renewables around 42 gigawatt. Solar, this is wind. So solar is around 67 gigawatt. So both of these have the major chunk, and then hydro, which is around 51 gigawatt. So the going forward, and the government says that they are aiming at 500 gigawatt of renewable energy installed capacity in another, 7 years, almost by 2030. So the major focus is moving into renewables. So from almost current, setup of 170, 175, it is likely to move to 500 gigawatts. So that is why the companies in this domain are actually shaping up well. There is a re-rating which is happening. You look at NTPC, 70 gigawatt of thermal capacity so far in the entire life of NTPC. Now they are talking about creating 60 gigawatt in renewables. And that is what we are seeing. Hydro also, we have seen a lot of capex happening now. The companies who are in the hydro power plants, manufacturing or setup, they are also recovering now. They are able to pay off their debt because of the better cash flows. And the companies, the OEM, the NHPC or Satlaj, they are also coming up now after the long period of stagnation in earnings. Infrastructure, across roads also, and then railways. I mean, this is where the projects are being awarded very fast and big orders are coming now. In fact, if you see Siemens order book, which is also catering to railways, that is almost full. And that is where one of the biggest order from railway has come recently. If such kind of orders are coming going forward, we may see a good capacity expansion by these companies. In fact, the order flow can also move into some of the PSUs linked to this particular area. So there are some PSUs, which are directly being benefited, and that's why that move is coming. For example, take the case of Bharat Heavy Electricals Limited. So BHEL. So BHEL has the book of almost 80 rupees. And on financial year 23 revenues, if you look at the current order book, it is almost 4 times than the financial year 23 revenues. That means the stock can become with a price to book of at least double from the current level. So from the book value. So if it is 80, it can be a mover towards 160 levels also going forward. That is how the situation is emerging. So this is the award tendering and awarding. So we have seen a good recovery in the recent financial year 24 starting. There was a good awarding actually happening, tendering and then awarding for the orders. L&T actually, if you see for an example, financial year 23, the order inflow prospects have increased in financial year 24 when we compare to 23. So almost 9,73,000 crores of prospective orders are coming up actually for the company, and that is why these companies are doing much better now. If you see the corporate linked banks, because now this is very, very interesting thing that the GNPAs actually from almost 11% in 2018, now it is reaching to 3.9%. The bank credit growth actually has increased to 15%. And out of this bank credit growth, if you see, the corporate lending book is growing by 6.5%. So that is where the corporate linked banks, for example, the PSU banks, where the NPAs are at almost very low levels when we compare with the last 10 years or 20 years, where the credit cost has declined. We have seen that the credit growth, in the corporate side, it is just growing still very low because the capex started late in India. It was more government capex which was happening, and that is where the average growth in credit looks like it is 15%, but the growth in corporate book, it is 6.5. So when it is growing, it is a time to look at PSU banks, the corporate linked banks actually, because once this book grows to 14-15%, then there may be a problem of the new NPAs coming up, but not now. And that is where actually whatever micro news are coming and which is impacting these companies, it throws an opportunity to, buy in the portfolios. Some of the names, where we have seen that EPS turnaround situation emerging recently. For example, if you look at, this is the EPS of bearing companies like SKF, right? You can see that this EPS used to be somewhere around 50. This was the average, and now it has, got doubled. So EPS has got doubled than the average. So what does it suggest? It suggests that going forward, even if some of the stock prices are a little elevated, they may go into time correction, but the sustainability of these earnings will lead to a bigger move in these kind of companies. So SKF is the beneficiary of both automobile growth and also the infrastructure growth, because 51% it is getting from industrials, and around 42% it is getting from the automobile. So it is a beneficiary of both. It has got approval for Class K and Class E bearings for railway freight wagons, which is also a big trigger, because from next year the dedicated freight corridor is most likely to be opened, which will be from Mundra port to the northern part of India. So these kind of bearing companies also are going to be benefited when the demand for freight wagons is increasing. If you see Naveen Fluorine, for a long period, we saw the EPS around 19 or 20. Now you have seen that it is in a new trajectory altogether. It has happened because Naveen Fluorine is also in the refrigerant gases, which is catering to air conditioners, and air conditioner has only 6% penetration in India, which is likely to grow more and much faster because of the lifestyle, a better lifestyle of the people. The buying demand actually for the air conditioners is increasing, and which may lead to more buying actually in the refrigerant gases. So this is direct, link, and it is more domestically oriented, right? Second, it is also in CRAMS. So we have seen that the outside companies are giving good orders in the CRAMS business, and that is the major driving force for Naveen Fluorine. I think both of these components, refrigerant gases and CRAMS business, I think this is the major driver actually for this company, and it is a relatively doing much better right now than the other chemical companies in India. AIA Engineering, you can see that the EPS, had little risen actually from financial year 15, but still the kind of move we are seeing now in the EPS, it is much significant, and that can lead to a better stock price performance. AIA Engineering has market penetration of 25% worldwide. It is in high chrome grinding mills, return on capital employed of almost 25%. Balance sheet with a cash of around 25 billion rupees, and this is the beneficiary of the capex in the cement pack. If you see the cement stocks, they are doubling the capacity because of the very high capex intensity. It is a time to look at the vendor companies to cement, because they are the major beneficiary of this. So the companies who are providing critical components like high chrome grinding mills, they are going to see the surge, and which is very clearly evident here. When I look at from the consumer discretionary angle, hotels, are one which are moving in a very sweet spot, because the coming 6-7 months in India now, they will see more festival demand. G20 already starting now. One day international cricket, World Cup is there. And then the Ayodhya Mandir also may be open in the month of January, more focus on tourism. And that is why the hotels which are already saying that they will increase the tariff rates by close to 20% in the coming 4 years, the companies who have a little debt, for example, Lemon Tree had a debt of around 1,700 crores on a market cap of 7,000 crores. This debt can be paid off, and that can lead to a better alpha generation in the stock. Torrent Power, I think power space is booming, totally domestic story, and we have seen a move towards renewables also. There is an increase actually of the transmission business also in power and the distribution business. So Torrent Power is in in the areas of Gujarat. It is in Daman and Diu also, Nagar and Dadar and Nagar Haveli. It is also in Uttar Pradesh, Agra. It is also in Mumbai at certain places, also going to be in Thane possibly going forward. So this company is, wherever it is showing a very high demand in power in their areas, and very, very efficient company. And that is where actually going forward, we believe that there is a very high growth which is expected in these kind of companies, particularly when the gas prices are also lower, which is used actually in the because they have more gas driven actually power plants. So this is also a big push for this company. Lastly, if you see the FI flows in Indian markets in comparison to all of these emerging markets, the flows in India have been much better, very clearly evident. If dollar remains subdued, it can lead to better flows in the Indian markets. Our forex flows, forex reserves have already gone back above $600 billion. The FDI flows have gone into 61 industries, very, very spread out. FI flows actually have remained resilient. So we believe that in Indian markets are the beneficiary of this. We believe that coming forward in the next year, there is a possibility that MSCI emerging market can remove South Korea from the emerging market bucket and can move towards developed market. That can also lead to a push for the countries like India. Already we have seen that emerging market ex-China funds being launched, which also is going to benefit India going forward. So India seems to be on a sweet spot. The intermediate declines in the Indian markets can be utilized to create portfolios, equity portfolios. And obviously, because we have seen a good earnings revival in the mid and small cap space also, the stocks or sectors which were not participating in the last 10-14 years, they are coming out, and that is where we need to focus more actually in our funds, and that is where actually we are also looking at. So this is all from my side now about the market, and if you have any query now, you can please ask me. So I am getting a query actually on the technology space, that how does this sector looks like. So I think the valuations in the sector actually had come down to very, very attractive levels, no doubt about that. The question remained of growth, and that is where we have seen that the companies where the base was little lesser, the mid cap IT, they started performing better. We believe that going forward, the kind of depreciation you are seeing in rupee, it may not happen. 5% depreciation per annum may not happen because of the flows which are coming into the Indian markets, because of our deficit situation, which has become better, and because of the government balance sheet. So this is where IT companies, may not be able to show you that kind of growth going forward. From attractive valuations, some kind of reversal is always possible, which is coming right now. I think after a certain level, you need to think of moving your money from this space to the more domestically oriented, companies. There is another query actually on the market about the textile space, because that is also one sector which was not able to perform for some time, and it is an exporter. So exporters are, because of the global slowdown, we have seen that the exporters are not able to perform, as I discussed about technology. But another point here is that a tactical view needs to be put in place, because if you see the FTA agreements which the government has signed, so almost 13 FTA agreements are signed. The UK is going to be signed going forward, and after that we can see some kind of reversal in the apparel manufacturers because of more demand of textiles there. So I think this is what emerging because of these free trade agreements. Even some export oriented companies you need to look at, going forward. If you see recently what happened to the chemical space, we have seen that in China, the manufacturing has dropped in chemicals and the prices actually have reverted back, which is good for Indian chemical companies. We have seen the price reversal in soda ash and some other segments, and that is where a good recovery is some recovery actually from the lower base we have seen in the chemical space in the Indian markets. So I am taking one last query, which has come actually on, finally on the auto space, because we have seen a good reversal in the automobile space in Indian markets. As I discussed about, bearing companies in India, auto ancillary is one thing which is definitely coming up. In fact, we had taken in our portfolios Bharat Forge also, because Bharat Forge was obviously it is there in forging, but also it is moving into defense. And we have seen a good move in defense PSUs. So some private companies also can see the reversal. We believe that automobile has made bottom in India, and the companies now are definitely coming up. More demand, more in the festival season is going to gear up. SUV has been the focus. So for some time, possibly small cars can see the traction, but the broader rural market is still in some distress. We have not seen that the monsoon is coming good in the last 2 months. There has been a big deficiency actually in the monsoon, and that is what can come back actually in the lower discretionary demand from the rural broader market perspective. And that is where we need to focus in automobile is the premium segments. The SUVs, the companies which are focusing more, they will gain more traction. If the SUV revenue is more in the total revenue, obviously those companies are going to get more traction, and that is where we are also focusing. So that's all from our side, and we wish very, very, good market investment from your side. Our views will keep on coming, and we hope that you will definitely get benefited from the views that we are giving, along with some logic, some facts that we brought in today also. So thank you very much and have a good time.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.